Welcome to The Explainer. Okay, let's jump right into this because we are looking at a massive, massive paradigm shift right now. We hear so much about the AI revolution, but it's officially hit a wall. And we're not talking about a wall of code or needing better algorithms. We're talking about a wall of pure, undeniable physics. We've got the data, we've got the brains, but we suddenly don't have the real-world resources to actually run these things. And Elon Musk, arguably the world's most visible AI pioneer, is quietly ripping up his old playbook to tear that physical wall down. So today, we're decoding his 2026 portfolio strategy, and we're going to unpack what it tells us about the very real, very physical constraints of our digital future. Now, here's the ultimate contradiction to kick things off. For years, Elon Musk has basically been the undeniable face of clean energy, right? We're talking electric cars, solar panels, massive battery farms, the whole shebang, pushing us toward a sustainable future. So ask yourself, why would the man who built an absolute empire on ditching fossil fuels suddenly make a massive, quiet pivot back to natural gas? It's a move that flew totally under the radar until it popped up in a regulatory filing. And honestly, it tells us everything we need to know about where artificial intelligence is really at right now. Check out this staggering number. Musk recently reached right into his personal fortune, quietly dropping a cool $1 billion to acquire a company called APR Energy. Now, what do? APR specializes in mobile gas turbines. Just let that sink in for a second. $1 billion spent entirely on fossil fuel infrastructure. Look, even for one of the richest guys on the planet, pulling $1 billion in cash out of your own pocket is a massive statement of conviction. To really understand why he made this wild bet, we've got to look at what's actually happening on the ground. Section 1. The billion-dollar gas bet. To make sense of this pivot, we have to look over at Memphis, Tennessee. That's where Musk is working around the clock to build two gigantic AI supercomputers, Colossus I and II, specifically for his XAI project and the Grok model. The ambition here is just astronomical, but the roadblock? It's incredibly terrestrial. The whole issue boils down to one word: speed. If you want to connect a massive data center to the traditional American power grid right now, you are looking at a wait time of 3 to 5 years. Why? Well, it's bureaucratic red tape, aging infrastructure, and a ridiculous shortage of the transformers you need to route that kind of power. In the AI arms race, 3 years might as well be 3 centuries. But on the flip side, APR Energy's mobile gas turbines, those can be set up in a matter of days. Bypassing the grid entirely lets Musk generate over 1 gigawatt of power almost overnight, getting those GPUs humming way faster than any of his competitors. Moving on to Section 2, AI's new physical bottleneck. Wall Street is absolutely obsessing over this right now. They're literally calling it the electrons are the new bottleneck trade. We aren't just building data centers anymore. We're having to totally rebuild and rethink the entire power grid to keep them running. To grasp the sheer scale we're talking about, look at these spending projections. The big 5 hyperscalers, so your massive cloud giants like Amazon, Alphabet, Microsoft, they are projecting an unbelievable $660 to $700 billion in capital expenditure for 2026. That's practically double the previous year. And the crazy part? This money isn't just going into software anymore. It's pouring straight into the physical world, buying up land, thousands of tons of steel, specialized off-grid power, and just raw electricity. You can see this shift perfectly in the market data. Traditional software, SaaS, is getting absolutely hammered. The iShares Tech Software ETF is down roughly 30%. Hedge funds have actually made something like $24 billion just shorting software stocks. But look down at those bottom rows. The industrial plumbers of the AI boom, their stocks are going to the moon. Bloom Energy, who makes off-grid fuel cells, is up 489%. Vertiv Holdings, a company that builds liquid cooling systems so these data centers don't literally melt down, is seeing order growth explode with a massive $15 billion backlog. So why this massive divergence? Well, investors are terrified that autonomous AI agents are going to completely wipe out the need for human-facing software licenses. Think about it. If an AI agent can do your company's accounting perfectly, you don't need to pay for 50 human licenses for accounting software anymore, right? Meanwhile, the thirst for physical power is so intense that even your classic oilfield service providers, guys like SLB and Liberty Energy, are actually forming joint ventures to power AI data centers. They are literally delivering natural gas directly to server farms. It just goes to show this AI boom is absolutely as much about megawatts as it is about microchips. Which brings us to Section 3, the massive cash burn.
Building out this physical future is incredibly expensive, and it is heavily bleeding the balance sheets over at both Tesla and SpaceX. Let's look at the financial climax of this whole situation. Tesla is right in the middle of what their leadership is calling a massive capex here. In Q2 alone, they reported a record capital expenditure of $5.79 billion. That's a mind-blowing 142% increase year over year, and all that cash is being rapidly deployed to fuel AI, robo-taxi development, and those Optimus humanoid robots. And you literally cannot spend nearly $6 billion without feeling some serious pain. That staggering spending spree absolutely crushed their free cash flow. Now, free cash flow is exactly what it sounds like. It's the tangible cash left in the bank after you write the checks for all this physical stuff. For Tesla, it swung to a negative $1.1 billion in a single quarter. This breakdown right here is incredibly telling. Look at how that unrealized SpaceX gain totally dominates the earnings. Actually, Tesla's core operating profit collapsed 57% year over year, knocking their operating margin down to a razor-thin 1.4%. Their standard operating profit was quite literally propped up by a $1.05 billion unrealized gain from their stake in SpaceX. It is deeply ironic, right? 69% of the world's most famous electric car companies' earnings came from a rocket company's accounting adjustment, not from selling cars. Meanwhile, SpaceX has been dealing with its own brutal reality check. The company's shares plunged more than 50% from their post-IPO peak, which completely erased $1.2 trillion in market cap. For Elon Musk personally, that meant his net worth cratered from $1.45 trillion down to roughly $695 billion. Just wrap your head around that for a second. That is the complete vaporization of $650 billion of personal wealth in barely 5 weeks. But here's the crazy part. Despite these frankly terrifying numbers, analysts are actually telling investors to just look the other way. Ignore the short-term cash flow metrics. As one analyst told MarketWatch, free cash flow just isn't the story anymore. Why? Because both Tesla and SpaceX are actively choosing to sacrifice short-term Wall Street expectations. They are totally willing to endure massive financial pain today if it means winning a 10-year physical war for absolute dominance in AI and robotics.
Let's look at Section 4, Testing the Data Flywheel. So the whole justification for these massive trillion-dollar valuations rests on this thing called the autonomous data flywheel. Basically, it's the idea that millions of cars collect real-world driving data, which inevitably leads to a flawless, self-driving robotaxi system. But if we look closely, the actual usage data is starting to stumble. Paid mileage for Tesla's robotaxi service dropped from about 1.1 million miles in Q1 to just 700,000 miles in Q2. That is a 36% drop, and it directly threatens this real-world data collection narrative that investors are completely banking on. To make matters worse, Musk recently dropped a pretty major technical bombshell. He revealed that the billions of miles they've already collected from the current fleet, they can't be directly transferred over to the new steering wheel-less cybercab platform. The dedicated robotaxi effectively has to start from scratch and reaccumulate its own data. It's kind of like spending 10 years meticulously teaching someone to drive a stick shift, only to realize the cars of the future don't have gears, pedals, or even a steering wheel. This is absolutely crucial, because the only reason the market gives Tesla a valuation so much higher than traditional automakers is this data flywheel promise. If this software narrative falls apart, all those billion-dollar data centers and massive megapacks, they suddenly turn into giant financial liabilities. And it's not just about the cars. The pressure's on the robots, too. Musk promised thousands of Optimus robots working in factories, but as of mid-2026, they're still mostly just doing internal training and data collection. Commercial production is still very much pending. And that brings us to our final section, the future AI profit pool. So where does this unprecedented shift from digital dreams to physical reality leave you and me as savvy investors looking at 2026? Well, Musk is definitely putting his money where his mouth is. On top of that billion-dollar gas turbine bet, SpaceX spent $329 million just buying Tesla megapacks for AI data centers in the first half of the year alone. He is heavily investing in massive, off-grid power to ensure his compute keeps running no matter what. Goldman Sachs hit the nail on the head with this one. Right now, chip makers and digital manufacturing are hogging about 90% of all AI profits. But that profit pool is rapidly flowing downstream. It's exactly like the gold rush, right? We're moving away from the people panning for gold in the river and moving toward the companies selling the pickaxes, the heavy machinery, and the water to the miners. The next huge wave of wealth generation is going to belong to the companies solving the physical constraints of AI, the power, the cooling systems, the grid components. Which leaves us with this one massive question to chew on. AI is no longer just some software story happening in the cloud. It is a sprawling, heavy, resource-hungry physical reality. The winners of this next phase aren't just going to be writing code. They're going to be pouring concrete and laying cables to bridge the gap between our digital ambitions and our physical limits. So ask yourself, are you truly prepared for an AI future that's built on mobile gas plants, thousands of tons of steel, and a totally rewired American power grid? Thanks so much for joining me on this explainer, and I'll catch you next time.